Hi everyone, and welcome to Vincent's Private Wealth's September 2025 investment strategy and market update. As always, joined with Kenneth Beanland. Welcome, Kenneth.
Thanks for having me.
Great. Right, today we're just going to run through usual topics, particularly the FY25 reporting season and market performance as we come to the end of that. Valuations and earning outlook, the macro environment, particularly the Australian and global economies, both of those, covering those, and the equity strategy and portfolio positioning.
Just an important message, general advice, and then on to the main show. Look, this year has been one of the most volatile years that I can remember in terms of what we saw for company reports through August. But just on the headline numbers. So we started off quite an expensive market, 22 times forward earnings, and that's just compared to really the last 10 years. And then what we saw was how did the big end of town really drive that? I've got to be honest, it was a bit of a disappointing result season for the larger companies in Australia. I think that can be looked at in two different ways. You've had a really big run up in financials, so the valuations are stretched. And then importantly, I think that when you're looking at those valuations, are they backed up by earnings? And that's where we've sort of the rubber hits the road right now in terms of the big end of town. If you strip out the big financials, so the big four, and simply look at the industrial side, so also taking out the resource sector, we saw some pretty heavy downgrades in terms of next year's forecasts, EPS revisions, which I'll touch on a little bit later. The shining light, and this is going to flow through across this presentation today, was consumer discretionary. That sector was by far and away the best performing sector, and I think leading into this reporting season, it certainly wasn't expected to be. We've had a number of years now where the consumer has been under pressure, cost of living, high interest rates. We'll touch on that a little bit in the macro side, but we have seen that start to abate, and I think that's going to be a running theme. The other aspect though, and I think this is really important, that we just spoke about the big end of town, running into some headwinds in terms of valuations and not being backed up by earnings. That small to mid-cap area actually performed better than average. We did see some positive lights after a number of years of underperformance. So that's something that we're watching as well.
And why do you think that is the case?
In terms of the consumer discretionary in the small to mid caps,
Yeah.
I think there's two major reasons. One, the consumer. The consumer has, I think, faced the worst of those headwinds. So I just spoke about that cost of living. That's starting to abate. You've had a number of years now where that interest cost, big debt that a lot of consumers carry. We've now started to see that interest rate cycle reverse. And then importantly, just in terms of valuations, that small to mid-cap area has been very, very cheap for a number of years now. And I think it is a good segue into the next slide, where we go and talk around what were those earnings revisions and what were the EPS expansions. The small to mid-cap area really, over that 12, 24, even 36 months, has been a really difficult side. And yes, you don't have the same balance sheet strength as some of the other big companies can, but I do think that move into that space isn't a flash in the pan. It's not a 1 month change. I'm starting to see that a number of these companies, and drift is really important, which I'll touch on, have continued their run post-reporting season. Volatility was up. Some of the big names, like I don't think I've ever seen CSL fall or move as much on a results day. That's Australia's fourth largest company, down 15% on results day, and really did drag that healthcare sector down, coupled with Sonic Healthcare as well. But how were those revisions and volatility matching up relative to previous years? So if you looked at it on a headline basis, you had really sales, EBITDA and earnings per share for roughly 0.1 to 1% to 1.7% respectively. Now, if you took out the banks, so banks very stable, they had slight EPS revisions upwards. You'd want to hope so, given the run that they'd had. What did the industrial sector look like? It wasn't a pretty picture. So sales for next year's forecast were revised down by 0.3%. At the EBITDA line, you had a negative 1.2% reduction, and then that's flown through into EPS at negative 3%. How has that compared to past seasons? It was a much larger decline. Typically those ranges, and we do see EPS erosion through reporting season historically, but typically those ranges only sit between 0.5 and 1%. Now onto that mid-cap area. This table to the left shows you what those EPS upgrades and downgrades were like through reporting season, and then really importantly, I think, how much revision there was in terms of how much you're paying for those. So the PE, price to earnings, the multiple revision that we saw. And momentum continues to remain strong. So if you had, and I'll just pick on AP Eagers, it sells cars, if people didn't realise, it's got good property exposure as well. But that consumer discretionary, I think if you were coming in to reporting season, where would you were expecting weakness? Absolutely in some of those larger expenditure areas. It surprised with an EPS, so earnings per share, surprise of 8%. Now, what did that actually translate into? The stock rose fairly significantly. It was about a 41% jump. Now, outside of that, what does that mean in terms of how much you're paying for that? So the dollar at which you're paying prior to, and now the dollar at which you're paying now, it moved about 30%. That's a very big revision. It means people are starting to potentially see a lot more earnings strength in those areas and are willing to pay on a one-year basis a little bit more than what they had traditionally have, because they've got confidence in that business.
There's a bit of a theme of confidence across the board there, particularly with the consumers. And you're talking about the earnings per share and the growth. I mean, there's a real risk around if those earnings per share fail to materialise. Absolutely. We're great believers in fundamentals. In the long term, that's what's going to drive markets. We are at higher multiple in terms of top line, but I do think that if you've got a company that has been unfairly treated by the market because of a macro theme, we can continue on with the consumer discretionary. So the expectations have been set really, really low over a number of years, and people have started to extrapolate out those earnings. Yep. Now, that's starting to change. You're absolutely right, though. If we start to do it the opposite way, if we start to do it and say, oh, these earnings are actually going to be upgraded on a continual basis, and they're going to grow at a quicker and quicker rate, that's when you're going to get yourself into trouble. Finally, just again, a top-line picture of the valuations. We sit at a fairly extended multiple, at least relative to history. So we've got to have reasons to do that. If we looked at the last 2 years, we had negative EPS growth on a top-line basis for calendar year 2024. We then had a look at the EPS for the last financial year. We had zero growth. We are expected to grow 6 to 7% in terms of FY26. We just went through and said that that's been eroded down. When you're starting at these high valuations, we really need to see that EPS line start to tick up. Just one quick question on that outlook stuff. How do you assess the sustainability of those valuations? Particularly in the context of that global economic outlooks.
Sustainability of earnings is paramount for a lot of investors. Like, you've got to make sure that you're in quality businesses. What we're looking for is a competitive advantage. I think that's really, really important, both globally and here. So I'll just pick on a name, Microsoft. I know that we're talking through the Australian stock market, but I think this is probably the best example that I can think of what competitive advantage is for sustainability of earnings over the long term. 2020, we saw the advent of COVID, and we didn't use Teams prior to that. there was some different companies out there, and everyone jumped on Zoom. Microsoft released Teams free of charge, absolutely free of charge. Then 2 years later, they started to price it. And now it's just part of that package that every year you get a 10 to 15% increase, you try and bargain a little, and you end up with a 10 to 15% increase.
Pretty much business doesn't open its doors today without using it.
But looking at those sorts of things, looking at competitive advantage, making sure that their balance sheet is in check, is their total addressable market still there? Are their valuations exceeding their earnings per share growth? So looking at price to earnings to growth ratios. And then really importantly, making sure that the end valuation that you're looking at, whether that is relative valuation or DCF, you've just got to make sure that you are laser focused, particularly when equity markets are high, on the fundamentals of those businesses. On to the Australian and really a little bit of a wrap on the global economy. And we'd like to thank Macquarie here. I thought they did a great job in terms of just summarising what's happening in the world. As many of you know, we have started in Australia over the past 12 months to see interest rate cutting, but we're actually quite late to the party there. So if you look globally, US, UK, Europe, these are the ones that we spend a lot of our time on. They've had at least 1 to 2% in terms of interest rate cuts already. So it might be that this starts to slow down. And what I actually found really fascinating when reading through this research report was Switzerland is now at that zero policy rate. So it was only 5 years ago that we were talking through negative interest rates. Turns out there's one already back there. So where does that lead us? I think that will slow. I'm not sure that we will see negative interest rates again. I know that we do have a lot of debt. European economy is slow, but still growing. But we think that there's going to be a moderation in terms of those interest rate costs, particularly domestically. We're expecting 1 to 2 more. We think around about that 3% will be the neutral rate for the RBA. But we've also got to keep our eye on the unemployment rate. So we've had a slight tick up, but we're still historically in a very strong employment market. And that's the same over in the US as well. Now, it's not in here right now, but the Q2 revisions for the US economy were at 3.8% annualised for their GDP, so how much they're growing. That's exceptionally strong. One of the strongest reads that we've seen over the past few years. And the expectation is for that to continue. So that's really positive for the economy. It shows resilience. I think it shows that corporate tax cuts and personal tax cuts are working over there. But what that does lead to is inflationary pressures. When you're growing fast, the job of the RBA or Reserve Bank, Federal Reserve Bank, is to try and slow that down a little bit. You don't want to get too hot. You don't want to see entrenched inflation. And that was the really big conversation that we were having only 3 years ago. So I do think there is some pause here. Now, political pressure aside, because that is a hot topic over in the US, I do think that their economy and our economy are actually looking pretty good.
With stronger employment and the economy's looking good, what's your view on the likelihood and impact of global monetary tightening cycle over the next 18 months?
So we're not expecting that.
Yep.
We're so close at home domestically.
Yep.
We still think there's reasons for interest rate cutting. Now, I said we are still at a relatively strong employment mark, but we have seen our unemployment tick up from around about 3.5 to the 4.1, 4.2 area. We want to see that stabilise, of course, and I think if you look behind the hood of some of those numbers, full-time employment has been falling, and it's been caught up by that part-time. So that's something that the RBA, I'm sure, will be watching. But I will pause on the US. So the US is growing at such a pace that I do think that if you start to look at these next 12 to 18 months, longer term down the track, I wouldn't be surprised if inflation starts to pick up there, and that might turn the corner in terms of not just monetary policy, but the incredible run that US stock market has had. Now, I said this was a running theme, but the Australian consumer is back in action. PCE, so personal consumption expenditure, this is a really important data point. So many of you may not know, but PCE really is a major driver of Australia's GDP, so how much we grow each year. It's about 55 to 60% of the GDP measure. That actually lifts in terms of the US. So if you want a strong economy that's growing, you really do want to see this PCE start to tick up. Australia is growing, and it's going at a quicker rate than what we originally expected. So for the first 3 months, we were sitting at about 2.4%. Yes, it's off a low base. Consumer confidence is off a low base, but consumer confidence I see as a leading indicator of this. That means people are feeling more confident about the economy, more confident about their wealth effect. Everyone knows about housing prices right now. And they go out and spend a little more, which is great. Does that lead into inflationary pressures? Will be a very interesting point to watch. I do think that with this though, we've just got to make sure that what I spoke about the US, you do want to see that PCE kick back up in action. There has been a slight decline there. I think there's reasons for that with tariffs starting to roll through. But can they withstand it through the personal tax cuts that they've had? Our belief is they can, and it's showing in the data at least.
Yep. Just on that data, because it's such a big part of the consumer spending, the PCE, other data points that you're monitoring with that, employment rates?
Yeah, so exactly what we've just gone through really. Yep. So consumer confidence, I'm a strong believer in terms of looking at the discretionary side. It marries up really nicely with what just happened in reporting season. Yep. So 3-year highs, very low expectations on the consumer discretionary side, on the PCE side, and lo and behold, we saw some above consensus numbers. Unemployment, absolutely, and I do think that the movements in interest rates are having a big impact in that. Yep. Something to watch, not just in terms of GDP or the markets, but yes, unemployment is low. If that starts to tick up, and we have seen some revised numbers in the US that were quite startling, really over the last 2 data points, you don't want to see that unemployment really ramp up, and it's a conversation that a lot of companies are having, or you're reading about in the press around what's going to happen with AI. How much is that going to affect the jobs market? Also in terms of, well, what's happening in terms of costs out. So that's closer to home, and I'll just pick on the major financials that have been in the press recently, just over some job cuts. So we don't want to see that move materially higher. That's a really bad sign for the economy. It will counteract any sort of consumption expenditure. People will start to close in, and you might actually start to see inflation really fall back. The other area, which is more in fixed interest markets. So fixed interest is a big part of what we do here at Vincent's. We have full asset allocation advice or advisory services. And when we're looking at where we want to place fixed interest for clients through our governance structures, a data point that we do look at is the spreads, so high yield spreads. So are you getting compensated to take on risk? So in private, in companies that don't carry investment grade, so the riskier end of town. We don't believe you are. We think that those spreads, as you can see here, are historically very, very tight. That means that there's a very small gap between investment grade and high yield. So you're not being compensated, we believe, for the risk that you're taking. When you're looking at that spread, yes, it moves up really, really quickly, but we think there's a lot of money right now in the world. We've got huge government deficits. There's a lot of capital chasing returns, and so people have decided, rightly or wrongly, to move in to this high yield area and compress the spreads, chasing that additional return. Now, we're unashamedly against that right now, and we think the data backs that up. You don't want to be taking on fixed interest exposure and not being compensated rightly for your risk. So, this is a very well-known chart, and it's just been released by Vanguard about a month or two ago. And what this shows is some select asset classes. So, US shares, Australian shares, you've got some Australian bonds, you've got cash, and then importantly, you've got CPI. And this just shows why it is really, really important that strategic asset allocation plays a part in anything that you do. Staying the course will deliver you the returns consistent with the risk that you're taking. Because as you can see, the longer this goes on, the worse the return in holding in cash becomes. And just as importantly, CPI is the silent killer there. Inflation is the silent killer. And I'd like to just point out that if you held in cash over the 30 years on Vanguard's expectations of historical returns that you got, you would have got around about $30,600, $30,700, around there. But CPI was actually around $22,000. And that's a huge part of your return taken away. Now, obviously, you've got to balance these risk and return profiles to your personal circumstances. You know, people need food on the table. You've got to have a cost of living that's set aside if required. But having the spread of assets not only smooths that out, but helps protect against inflation. And another graph that I think does back up the mantra of staying invested is the one on the left-hand side. So what this shows, I think, is really, really interesting. This is the 3 months, 6 months, 1 year, up to 5 year returns from if you were invested at the very top when the market made an all-time high. It actually shows that if you had invested then, you're actually pretty much better off every single time period over greater than a year than all other times. So just because markets are high, there's generally a couple of reasons for that. Earnings per share are strong. So I haven't touched on the US, but they're double-digit earnings growth. They are at record highs. They very much, I think, deserve some elevated valuations relative to what we have in Australia, and they're trading on it. But the other side is that falling interest rates. So that goes into DCF valuations. It means that your opportunity cost is less, so you push into the markets. And that's something that you do need to be watchful of, because that can go both ways. The other area is just the returns that we took from that Vanguard chart on the right-hand side. Absolutely, it pays off to stay the course. US shares have been above 10% for the last 30 years, so it's 10.8%. The Australian share market has actually been the next best performing, and that's at about 9.3%. We always say that if you take those, if you add the international shares as well and have a nice blend, that 9 to 10% through cycles over 30 years has what traditionally has been the expectation. On to what keeps us honest. This is what we presented in our April market update. We thought that there was going to be moderating inflation, and what would that be positive for? So we thought the property sector, so through MVA, RCAP, and then gold in particular, we thought was going to have a pretty strong period, and that's not just with inflation falling, that's around the amount of debt that's being issued right now by global governments. So that devaluation of the dollar.
Maybe just touch on that, because it seems to be a constant theme. Can you explain its role in a portfolio? When you're considering something like gold,
sure.
And what impacts it?
Probably talk on a general context,
Yep.
Because if you think around personalisation, some people
Sure.
really do require that income focus, and
Yep.
so gold not being an income-focused asset may not form part of their portfolios. But in general, you're looking for something that has an alternative driver to equity markets and fixed interest markets, so you get a diversification. So something that's uncorrelated means that what's going to happen for gold if it goes up or down isn't going to be affected by or influenced by the movements of the US share market or the Australian share market. So share market moves up, maybe gold stays flat. Share market moves down, maybe gold moves flat. You're not looking for negative correlation, which would be the opposite way. We just think that if you're looking at this in terms of portfolio construction, it certainly has had a place in there, and we continue to believe it does. Whether you look at gold miners or in an exchange traded format, or the physical gold for a little bit lower volatility than what you see in the gold miners, is something that is quite nuanced to a client's perspective, but that's why you have it in there. So global growth slowing and interest rates dropping, we thought quality would continue to outperform. This was an area that we certainly got wrong. There's a couple of names in there. One that we did exit, but BlueScope, CSL and QHSM. QHSM is a hedged version of a quality ETF, and it's the small to mid cap area. Now, I would say over the last year or so, that has been underperforming. Just like I spoke about that small to mid cap space, that's now reversed, and that QHSM, the small to mid cap area, globally has started to see an uplift. Australian financials fallen back down to earth. We would say that the largest bank in Australia has actually started to see that reversal. So 1 July CBA, I don't have the exact number, but let's say it was around about $190. As at time of recording, it's around about 166. That's against a market that has gone up. So that's being used, I believe, as a funding source. That valuation has started to drop back. Still very, very expensive in our opinion, and we continue to remain underweight financials for almost all clients.
Since you remain underweight, what factors would shift that position for underweight financials in Australia?
Great question. I think there's a couple of things that are key, and then I'll touch on what are the drivers of that. So we would love to see valuations drop back down. That would get us more confident in buying something on a fundamental basis. But really, what's going to drive that valuation declining? Is it going to be a fall, or is it going to be the earnings per share growing? The earnings per share that's requiring that we would like to see would be above trend. We're not there yet. And I think that what we need to see in those earnings per shares is we see those net interest margins. They drive 85% of the bank's earnings per shares. We need to see that expand. So what they're making when they're loaning out money, and what they're receiving when they pay out interest, we would love to see that at a bigger margin. I don't believe, for a number of reasons, that that's going to occur. We're in a very, very competitive market. And I do think that, rightly or wrongly, it would be quite political for our banks to have outsized profits at this point in time. Another area that we've been looking at in terms of, I'll just stick with equity markets or growth markets right now, is private equity. Looking at undemanding valuations relative to global markets. So this was all back in March, and we continue to believe in that. And then we're very, very big on Australian financials fixed interest. So yes, the capital notes are quite tight right now. They're still around for another 7 years, but we've been actively moving towards the subordinated debt market. We continue to think that the risk and return profile, really important on the risk in fixed interest, is something that we think the Australian banks have. Moving forward, we continue to think that the moderating inflation story is still here. So we're still with the MBA, the gold, and we've added a new position in wire, so that's copper, for a couple of other reasons, but we still like that. Copper being undersupplied right now, thoughts of with that terrible tragedy over in the Philippines with Freeport-McMoran, but that's 3% of global copper that's been taken out of the market in already an undersupplied market. So we do expect the copper positions to remain strong. We still like quality compounders, and we touched on compounding competitive advantage. We think that CSL's share price decline has been unfairly met by the market. We like Microsoft, we like Meta. Alphabet was, I think, a hot topic at the start of the year. AI was going to eat its lunch. It's actually been maybe not the best performer, but one of the best performers out of those Mag 7s this year. And then finally, Netflix, competitive advantage. We think that that's a quite a good trade into October. With valuations high, we do need to start to have a look at a little bit more in terms of that diversification between passive and active management. So private equity, we're looking at the mid-tier market. So smaller businesses, that 50 to 300 mil, I think looks really attractive right now. You've got a lot of family-run businesses that may not want to pass through to that next generation. And I think there's an opportunity there for private equity to come and assist those types of companies. Active management. We think that with the top line of the Australian stock market or the US stock market is quite high, passive money continues to flow in, but we think there's opportunities underneath the hood of those markets. So GCQF is a new position that we've been looking through. I mentioned it before, we are unashamedly continue to be underweight Australian financials for almost all sets of clients. And then I think another an area that is becoming more prevalent in our markets is private credit or private debt. There's $40 billion worth of hybrids coming due over the next 7 years, and it's no surprise that fund managers do see an opportunity there. We think due diligence on managers is exceptionally important. We think that there's going to be a lot of operators here that may not have the skills and expertise to manage a down cycle. And so making sure that you're very comfortable with your exposure, very comfortable with your manager, I think is going to be really important in that space.
Can you talk about, maybe expand on this due diligence process, particularly, you've got the private credit and the private equity. Can you talk about perhaps how liquidity plays a role in that space?
Sure.
Or
so I suppose,
consideration.
Consideration. I think if we're looking at that due diligence aspect, firstly, you've got to meet the manager. So meeting that manager, making sure that they've got a long track record, making sure that they've been through cycles before, making sure that there's a roundtable discussion, that you've got multiple people having eyes on these documents, I think is ultra important. Now, you mentioned liquidity. Liquidity shows up, and the need for liquidity shows up at the worst time. And I can assure you that through a GFC, through an extended period of recession globally, private credit is going to have an exceptionally hard time liquidating these. So you've got to make sure that you can match your liquidity horizon and be able to hold on to these if you're going into that space. If you've made the decision on the fund manager and you've made the decision that you're comfortable with their due process on how to deal with bad situations, and you've entered into it with a position size, you've got to make sure that position size you're treating as an illiquid asset. Because yes, they might have monthly withdrawals or quarterly withdrawals, but if there's a run, they will be gated and you will not be able to get your funds back. So it's ultra important to have a look at liquidity and matching that with your personal circumstances, really.
I guess that extends to matching that with the overall portfolio to ensure that if you're going to take, for want of a better word, illiquid positions, that you need to have the liquidity in the balance of the portfolios.
Couldn't agree more. The Australian consumer has been the surprise packet of this reporting season, and we continue to think that that's going to surprise markets. So we're looking at active management within that small to mid-cap space, so FSML. We also really like some of the more luxury goods brands, so I've just picked on Ralph Lauren and Louis Vuitton, but the consumer, we think, is going to continue to drive the Australian and the US market. We still remain hedged. So this has been a long position for us now. We started hedging at the back end of 2020. through the depths of COVID. We made our first transition from an unhedged product to a hedged product. So that was QUAL to QHAL. And we've slowly been doing that over these last few years. We think that the US dollar is going to fall, and we think that there's going to be upward pressure on the Australian dollar. So we remain hedged where appropriate.
What helps derive that view that the US dollar will fall?
Yeah, certainly. There's a number of reasons that really go into it, and I think budget deficits are a major benefactor. Yep. You've got government yields, so if you looked at the Australian 10-year yield compared to the US 10-year yield, it's actually pretty attractive right now. So that means people are going to move into that market. And I think that in general at least, if you're looking at above trend growth for US and we're seeing that uplift, Australia's a risk-on currency. So there's a number of factors there that we continue to like. The devaluation of that USD is something to consider. When that occurs, you do start to see some of those emerging markets really start to catch a tailwind. Risk-on assets potentially helps with commodity prices as well. So all roads lead to Rome. We'll be sitting here in another 6 months. But a little bit about our SMA update and how we deliver our advice. So I mentioned a roundtable discussion on due diligence. This is our investment committee. We have a number of either advisors or specific analysts within our division looking at the Australian equities and asset allocation that we put in. Income model portfolio, this mandate is really around having sustainable above index income from the Australian equities component. So it leads you to the bigger end of town, more mature businesses, robust balance sheets, and companies that have been through cycles before.
It seems particularly important, when we look at now the pursuit of yield in an income model, this is all about how to avoid that excess of risks. And maybe you can explain, the terms value trap as well with that.
So a value trap is simply that is too good to be true. You are not paying attention to specific risks in that company that have made it into a structural decline, where you're going to face dividend cuts, so the yield drops. And so when you're looking at a value trap, you're looking at an undervalued company that has real reasons to be undervalued. You want to try and avoid these because you will, at the end of the day, have a position that will underperform materially over a long period of time. The balanced model portfolio, think of this as a mixture between growth and income. We're really pleased with how things have gone. Now, keep in mind when you look at these numbers, we have been underweight Australian financials.
The importance of that, particularly around the component against the index there.
Oh, yes, sorry, yes. So if you think the index has had a very, very strong period, that has been driven by those Australian financials, CBA being around about 12% of our index. And so this, I think, is really set up for this next 6, 12, 18 months, where we're very, very confident that fundamentals will matter, given the elevated levels that you're seeing some of these Australian financials.
Yep.
And finally, the growth. This one has a little bit more volatility within it. We are looking for positions that have large addressable markets, may trade on higher multiples, so you're willing to take on the position that their future cash flows are going to be better than what we're seeing right now. And I think really we do prioritise earnings in order to deliver that long-term capital growth. This is how they've gone. Reinvestments really important here, so nothing's been paid out, everything's been reinvested, and that's just relative to the market.
One quick question to close this out, and it's really around the long-term themes. So when you're looking through those portfolios, there's a lot of positioning taken into consideration, economic outlooks, the earnings per share growth, where all the fundamentals are on that, consumer trends, and then you're overlaying that with structural trends such as digital transformation, and then you even touched on a little bit of that intergenerational wealth stuff with the private equity. You talk about how you're positioning portfolios for those long-term structural trends.
A really great question. We do it in a number of different ways. So again, when we're looking at private markets, we have moved into venture capital. So looking at specialist fund managers, looking for that next superstar company. And so I truly think that 5 years ago we wouldn't be talking around OpenAI being a private company at a 500 billion market capitalisation. I just don't believe that would have been able to have happened. And so these next generation of companies that are coming through, they're staying private for longer. And having a specialist manager involved in that area, we think is important for a lot of clients, because you do take significant risk when you move into those illiquid assets. The other thing that we're looking at, or the other area that we're looking at, is are the companies that we're in, are they sustainable advantage, their moat being attacked, and are they leaders in this space? So I mentioned a couple in there. So we've got Microsoft. Microsoft, I think, has the clearest line of sight towards AI through its Copilot adoption. They are spending, and I think really importantly, they have shown slight discipline in here, while other companies have not. And are they being able to monetize this opportunity and set themselves up for the future? And that's really going into our portfolio construction around what's our position size? Are the fundamentals there? So can Microsoft continue to operate, and can it continue to deliver earnings per share growth for our clients, is really important. And so looking at these structural changes, we've just got to make sure that for our clients, are we taking on excessive risk? Hopefully not. And are the businesses able to withstand, or even use this as an opportunity? Is this going to be that productivity gain that I think you're starting to see over in the US?
Just a quick one. This is probably a little bit left field that I'm not sure if we covered. Well, I don't think we did. You know, the themes around the US GDP growth, how that flows through to energy?
In terms of the outlook for energy,
yeah.
Well, energy usage is going to go through the roof in the US. There's a lot of talk about nuclear energy. Now, when you look at the Australian stock market, we have some uranium hopefuls, I would call them. They're close to production. They've either mothballed production, but they're not in production. So we need to make sure that if we're looking at that sort of energy and energy usage, are we in companies that are up and running and able to benefit from it now? I do think that in terms of the commodity side of things, so if we looked at coal in particular, there's not many new mines coming on, and that means that the supply is quite tight. And we do think that with the increased output that we're seeing over in the US, China has been difficult for a while, but there's signs that that's starting to come through. That should lead to quite substantial demand. Now, either in thermal, yes, but really in that met coal area is where we're focused on. And then in terms of energy and LNG and oil, that has been an underperforming position for quite some time, and a sector for quite some time. We would have liked to have seen a bit more of an energy tick up with the US dollar falling. They're negatively correlated. But we have just seen in the last week or two a nice little pickup in the oil price. So we're positive on energy, but we are very, very specific in terms of the companies that we're invested in, we're quite favourable on the coal outlook.
Excellent. Thank you for putting you on the spot there. Wonderful. Again, appreciate your time. And we'll close that out, but if you do have any queries, by all means, feel free to reach out.
Thanks very much.
Thank you.